In this section, I will be explaining trade entry techniques and life after the scoring table. You see, introducing something like the scoring table is the best way to illustrate why a particular area is considered to be a good trading location, including a number of different probability enhancers and filters. Therefore, by taking you through a systematic approach where you have to use a step-by-step checklist and then to obtain a score, off of which you will then make the final definitive choice between only two alternatives, taking a trade or not taking a trade, is actually known as the binary decision. Without this tweak to your trading brain experience, you won't be able to move on to the next step, which is if-else conditional logic, required in the more advanced stages of your trader development. But there is a life after the scoring table and a more efficient use of developing price action instead of just using limit orders. So let's take a look. Let me begin by saying that the scoring table from the first part, or the first section of Mastering Supply and Demand, is an educational tool first and foremost. Now, once it becomes second nature for you to look for possible issues when it comes to the opposing zones and higher time frames, all of the stuff that you have in the scoring table, such as making sure that the arrival is clean, that there is sufficient space between your entry and your intended target, and all of that good stuff, you can then begin to use supply and demand in combination with developing price action on a much smaller time frames. So now, instead of using just limit orders, there is an option to wait until the developing price action shows you the way. And this approach will also mean that I'm going to show you how to use a lower time frame, such as a 1 hour and 30-minute charts, to possibly minimize the stop loss that's necessary to trade a large zone from that higher time frame. Scoring table, if you remember, calls for limit orders on the levels that scored high enough. Now, one problem that I started to have when I was developing my own trading style was that sometimes I would see a zone at a swing extreme, but it wouldn't score very well. And yet in the aftermath, the zone would end up being reactive. This was the case with especially with a lot of offspring zones in particular. So I started to have a bit of a dislike to limit orders, because even with the scoring table, it still felt a little bit like guesswork, because you're kind of guessing that a limit order might work out. Whenever I managed to find another way of doing something more efficiently in trading, it would always start with this like little niggling feeling that there could be a better way, which kind of leads to a lot of research, a lot of journaling, and then eventually I find a way how to do it. Now, at the time when this was happening in my head, I was also a very new prop trader attempting to translate this swing strategy of supply and demand into intraday. And I'll be honest with you, I was not doing particularly well at that point. My stop losses were way too big, and the limit orders that would trigger would have to be closed by the end of the day. So I would close the trade and then come back the next day to try and find another entry, but usually the price would move away from my initial desired entry price. So now it would require an even larger stop loss. The limit orders were actually working against me. At the time, I knew nothing about market profile, and it's not going to be probably another 2 years before I learned how to use profile with supply and demand to serve my purpose. But I did notice instinctually that using a 30-minute candlestick pattern at a larger supply or demand area would actually show me the rejection quite accurately, particularly at the right time of day. And then I also noticed that I could base my stop loss on these 30-minute patterns rather than the entire enormous zone from like a 4-hour or a daily chart. Another tool that I started to find incredibly useful during the later part of the day is the average daily range. In particular, average daily range exhaustions. What average daily range does, it takes the daily price movements from the last 20 trading days, and then it calculates the mean average. That becomes your expected average movement on a day-to-day basis. Even if you're not interested in trading intraday, using ADR to time your trades can be a big advantage when it comes to entering swing positions. And this is where Blatek DR can help massively. Blatek DR stands for Blatek Daily Range, and I'll pop the link in the resources section somewhere so you can check it out if you wish. Now, Blatek DR is the very first ADR tool that shows you where the exhaustion range lines are, and then if the price reached the lines, they will turn from dotted into dashed lines. You should think about ADR exhaustion as your intraday swing extreme. So you can imagine if you start to combine this statistical tool with something like a 4-hour or a daily supply demand area to get a very accurate idea of where your strong trade location can be. However, ADR exhaustion can really only be efficiently used during the New York session for one very simple reason. Asia and London moves happen very early in the day. So any exhaustion of a statistical norm, which is what average daily range is, it means that you're likely looking at an abnormal day. So price shouldn't exhaust the entire 24-hour range in the first 2 hours of London trading. If you're planning to continue learning with us with Market Stalkers and Blatek to learn intraday trading, then there will be talk about session ranges as well and how you can further utilize those kinds of statistics if you're trading Asia or London. Let's start with the topics that you're already familiar with, because average range exhaustion is a pretty simple concept. You would aim to get your entry as close as possible to the daily range extreme. In the top-down approach lesson, I was talking about using weekly conterminous lines from just a mere engulfing pattern, not even a supply-demand area. And that is certainly one choice to have in your trading weaponry, should you happen to run into a conterminous line on a weekly or even a monthly chart. Your first step would be to identify the weekly or monthly conterminous line, which indeed can be in the middle of nowhere because it's such a large time frame. Then you'd combine this with a cue point from a daily or even a 4-hour chart to look for your entries, either by locating supply and demand on that time frame or by reading development price action. So the principle here is very similar. This next option involves using a daily supply-demand zone located at a swing extreme. So ideally, you do need a cue point on the daily as well. But there are times when the price has rejected a daily cue point via a rejection pattern of some sort, which gives you a brand new conterminous line for a bounce trade. For example, here there is a test of an older daily Q high that came from like way back. But the point being is that one of the candles actually leaves the Q point area, and I've marked it in this kind of yellow orangey rectangle. Now this event is your development price action rejection signal. It's a reversal signal, right? And one that leaves a Q point area as well. Now, if you've trained your eye to look for these newly formed conterminous lines already, you will notice that there are really two conterminous lines created. One up here where the red line originates, and then another lower one right at the daily Q high. Now, the problem with supply-demand limit orders is that one originates in supply where you're actually seeing this whole sliding consolidation pattern is actually massive. Like if you look on the daily chart, it spanned 340 pips. So what are you going to do? Place a limit order with 340 pip stop? No thanks. I would like to make some profits before dementia sets in. And then two, the newly formed supply actually looks pretty weak. And it's so new that it doesn't yet satisfy the 3 to 5 times profit margin either. This price action here seems like it's almost suspended in air if you're not referencing that larger time frame conterminous line. And then three, you have no idea which one of these new conterminous lines might end up being reactive. Then 4, you still need a massive stop loss, even if you were to trade these conterminous lines. So, okay, it might not be 340 pips, but it might still be over 100 pips. It's still too much. But now you know about the market structures, and you know about the phase 3, and you know that phase 3 is almost always followed by a liquidation. But supply and demand says no. So let's approach this another way. Mark both of the conterminous lines on the daily chart, and you will see me do something like this in my weekly YouTube videos. And by doing that, you now know in which areas you want to become a seller based on this developing price action you're seeing on the daily chart, like this. So now you have 2 conterminous lines. Remember, we're kind of looking after this candle dropped out of the daily Q point, so we don't know which of these is going to end up reactive. If you've subscribed to our YouTube channel, if you just type in Market Stalkers on YouTube, it should come up. You will see me do these kind of lines and orange rectangles frequently in the weekly strategy videos. But now that you have these 2 conterminous lines, let's imagine that this whole move away didn't happen yet. So now all that you can see is just this. Starting from this top, you have the bearish engulfing. Then you have a test, rather deep test of the newly formed conterminous line that doesn't leave the Q point area yet. But the very next candle brings the move that we're looking for. It takes the price out of the daily Q point quite confidently. But now it creates another conterminous line, which is awesome for us. Either of these lines may become the one that actually brings you that bounce in the opposing direction. You don't know which one. It's the uncertainty of the market. You don't even know whether there was maybe an intraday reaction from this very first line. You cannot see that on a large chart because you're only looking at the daily chart. So whatever happened intraday, it's not going to be visible in most cases. And as you will see, you don't actually need to guess which one of these is going to work out because you will be able to see this on a lower time frame. And there will always be a price action clue. So now, what I'm going to do, I'm going to take you all the way down to the 30-minute chart, still keeping these red lines and the orange rectangle for orientation. So here's what that 30-minute chart looks like. I've zoomed out quite a bit so that you get the full picture. But here is this first conterminous line, and then there's the second conterminous line. The vertical green line is there to mark the beginning of the next day. But I will say this, using low intraday time frame levels and price action will only be relevant for that day. Just like you wouldn't use average daily range price levels from like 5-6 days ago, because they're not relevant for today's trading. In the same way, you cannot look at a 30-minute chart supply-demand levels that have happened several days ago. Because there are different circumstances, right? There are different players, and ultimately, you do want to make this a hard rule if you're trading from a low time frame. Levels created on a 4-hour chart and lower time frames are only ever valid for maximum 24 hours. If you're trading for a 15-minute, 30 minutes, and 1 hour, these are only actually valid for maybe a couple sessions, so let's say up to 12 hours. As a long-term trader, I can tell you that low time frames are only ever useful for developing price action. Expecting a 30-minute chart supply-demand areas to work out, just like they work out on larger time frames, it's just asking for it. And if you're wondering why this is, it's because there's simply not enough trading information on those low time frames to justify any long-term swing moves from there. And this is why I see people constantly getting stopped out when taking trades from previously established 30-minute levels. This is a favorite pastime of market makers to take out the recent highs and lows from these immediate areas. If there is an established London session low, it is very likely that the New York market makers will smash right through that low, just enough to annoy the retail traders, before taking the price back the other way at the correct time of day. So back to this chart. Now the vertical green line, like I said, it marks the start of the next day. At this point of the course, I do expect you to already know your candlestick patterns, such as bullish engulfings, inside bars, morning and evening stars, and all of that good stuff. If you're a bit shady on these, I do have a candlestick workshop as well. It's only short, it's on Udemy, so you can go ahead and watch that. It'll only take up about an hour and a half of your time. For this course, I did specify that you need to be very good at reading candlestick patterns, and here's why. Once the price reaches one of these lines, you will be looking for a rejection candlestick pattern, and not a bazillion candlestick patterns available out there on the internet, but you're really only looking for 4 of them. Engulfing, consolidation, ideally ending with engulfing, evening star, or morning star. In this case, I'm expecting a bearish rejection, so it will be an evening star, and finally an inside bar. They are in order of probability. So engulfing has the highest probability of working out, then the consolidation, then the evening star, and then the inside bar is the shadiest of those, because it can turn into a consolidation. Now I'm going to push the LaTeX time machine forward and then zoom in a bit. Okay, so the price has reached the first conterminous line. Remember, this is a 30-minute chart. Right, you can see it here. So for any decision, you will need a minimum of 2 candles before you know whether you have a trade entry or not. I usually have alerts set at these conterminous lines, so I don't just sit there waiting for the price to reach conterminous lines for hours and days on end. I just set an alert, I walk away. When the alert triggers, it sends me a text message to my phone, so I can then go to my trading desk or log into it remotely if I'm away from my trading desk, and watch the price for the next hour, maybe a couple of hours. Once you have that alert, you want to see one of those 4 patterns that I just mentioned. And remember, you still don't know which conterminous line will be reactive, which is why I'm down to the 30-minute chart, attempting to use that 30-minute pattern for my smaller stop loss. And therefore, you will also have a shorter trade duration expectation, because you don't have to hold it for days and days and days on end, because you're not looking for a 300 pip move. You will only typically be looking to bank about 80 to 100 pips. So let's push this along just one more bar. So now I have an inside bar. It's not the strongest signal. Engulfing would be a better option. I'm not that crazy about trading inside bars, if I'm going to be honest. More often than not, on the low time frames, they tend to turn into consolidating moves. In this case, you would have a bit of a flimsy entry at that first conterminous line from the daily chart. So let's see what followed. It actually brought a nice pullback intraday, but it wouldn't have been the biggest trade. I mean, if you entered this on the back of the inside bar, you would probably bank about 1.5 times reward risk ratio, and then the next session already kicked in. If you're trading intraday, whenever the next session kicks in, I cut my intraday trades off. I don't hold them over the next session. So if I traded London session, the trade will be already over by London noon. If I traded New York, the trade is usually cut at New York close. Sometimes even before that, a couple of hours before the New York close. There are loads of traders out there who never make the distinction between the rules for doing an intraday trade and the rules on doing a swing trade. Stop loss size being one major rule. For a swing, you generally need a much larger stop loss if you want the trade to survive for longer than one session. Using a 20 pip stop and then expecting that this will be enough to survive for more than a few hours is just not very realistic. If you're using a small stop loss and planning to keep a trade longer than a day, you really need that large move away from your entry on the day of trade execution. So you need that move that holds higher or lower on the day as you go into the close of the day. In that case, you might be able to keep this trade overnight. Otherwise, you're just playing with fire. Especially if you're trading something that tends to gap and closes overnight, such as DAX and natural gas. Natural gas is actually known as the widowmaker because of this, because it has these like enormous gaps and you never know what's going to happen. So trading it from like a swing is just not an option. The first thing is that the entry signal that you're looking for a swing trade or potential swing trade, it needs to be much stronger than just an inside bar. So for this example, it might be suitable for like a quick opportunistic trade, and it will maybe last for about 2 to 3 hours at most, but this is not, this inside bar is not the signal that you will be looking for. And then also, this particular move happened way too early in the day. It was still the London session. I avoid doing any swing trade entries during the London session because more often than not, New York has these option expiries happening every single day on Forex pairs and some commodities too. And what this typically means is a complete reversal of whatever move London has done. So in a way, New York Stock Exchange is much easier to trade because not only do you have this expected behavior at a particular time of day, but you also have the possibility of the average range exhaustion too. So if I push the Blatek time machine to the beginning of the final 3 hours of New York Stock Exchange, you can see that the price actually completely reversed the London move and just carried on through. So there was this fake out of reverse hammer. I don't trade hammers and shooting stars exactly because of this. Maybe if they're on a very large time frame, I may consider them, but they always get retraced on low time frames. So this initial move was completely reversed during New York. Here is what it brought. This is a strong bearish engulfing. At this point, you now have your strong entry signal for your swing trade. How you execute your entry will be entirely up to you. Some options for trade execution, like for example, one of them would be to enter as soon as this bearish engulfing candle closes with a stop loss slightly higher than the engulfing pattern high. For swing trades, you really don't want to skimp on the stop losses, so doing something like this is not a good trade execution practice for swing trades. Another thing you need to ensure with stop loss placements in general, which is like a whole science in itself, but in the simplest way possible, stop loss placements generally need to go below or above the round numbers. So in this case, we're looking for a short, so you will be looking for a stop loss to go above 1290. And that's because you have market makers and you have institutional HFTs, which stands for high frequency trading systems. They all love taking out these round numbers. So by positioning yourself with that in mind, you obviously get a much better chance of your trade to stay in, to survive. It's even better when you can actually obtain an entry above the round number for a short. But obviously the markets are not an exact science and you cannot control where the market turns. But what you can control is where your stop loss goes. Now in this case, for a swing trade, now you're looking at a 60 pip stop loss instead of like over 120, which was needed for the entire area on the daily chart. So using this technique, you've more than halved the amount of stop loss needed. I started this lesson talking about limit orders. Well, here is where limit orders might come in useful. It's a slightly different way to approach them. So it's not to run a limit from a previously identified supply-demand area, but instead to minimize the stop loss even further. It's all to do with newly formed conterminous lines. So in this case, you have a newly formed conterminous line on the 30-minute chart engulfing pattern. Okay? So that would be another option. A pending order at the conterminous line of the new engulfing pattern. This entry technique would then further minimize the stop loss needed to only 45 pips without compromising any placement of your stop loss. But one issue with this is that the pullback into the conterminous line may never come. So you may never get a fill, which is always a danger with limit orders. I use both of these entry techniques interchangeably, and to be fair, I rarely use limit orders for them. I kind of observe and I judge the movement of the next candle, and then I decide whether I will wait for the conterminous line pullback or I will execute the trade right away. But if the stop loss required is not too horrendously big after that engulfing candle is done, I will just enter the trade. Now this is the part where I want to explain about accuracy and drawdowns after you've entered your trades. We get a lot of emails from people who are obsessed with not having any drawdown on their position after they've entered the trade. So they're looking for some kind of microscopic accuracy post-trade entry. thinking that somehow this will make a difference to their trading. But listen, this way of thinking is a result of fear-based behavior. And it's an attempt to make yourself more comfortable because you're not entirely clear on the reasons you've entered the trade in the first place. Or you're trading positions that are way too large for your trading account. So by expecting the trade to quickly move in your direction, kind of validates your belief that you're correct. The questions I get are usually along the lines of how accurate is your method when it comes to entries, and will I experience a drawdown after entering the position? And it's always the same. They carry on to explain that they find it difficult to stay in a trade that draws down 10, 20 or 30 pips. And it's total nonsense, okay? It's all based on their own psychology. You do not need zero drawdown after entering a position. In fact, by looking for something like that in a trade, and then closing trades because they've moved in your direction after about 3.2 seconds is a behavior rooted in fear. Nothing more, nothing less. Having a position go into a drawdown will have no impact on your ability to be a consistently profitable trader. It's a fear-based behavior that you really need to deal with. And like I said before, it usually comes either from the fact that you are not sure on the reasons why you entered a trade, or you're trading way too large a position size. Therefore, you're seeing these like huge movements as your trading capital goes up and down, even with a 10 pip drawdown. And this means you must decrease your position sizes. Now let's go back to that chart that I was looking at earlier and see what happened with the price after we entered the trade from that 30-minute rejection. Look how long this took to move. That's 3 hours of waiting around, and then finally it jumps off a cliff. So if you're a twitchy trader, kind of waiting for zero drawdown, instead of getting a beautiful trade that went on for days, you'd be exiting already like somewhere here. But even with intraday trades, they take time to work out. You will not get a trade that lasts for 10 minutes and then you're gonna get, 10-to-1 reward risk ratio. You need to let the price do whatever it's going to do, and that takes patience, it takes time, and it takes some emotional resilience as well. If you're struggling with all of this, I suggest you kick off a trade and go do something else. It will help massively. Whilst I was learning how to trade, I renovated basically my entire house. I sorted out the garden. So many hobbies just to keep me away from the charts, from looking at the chart every single minute and imagining things in front of my eyes. And then over, a number of months and a year or two, this became normal and I'm completely comfortable executing a trade and walking away.